Good morning, everyone, and welcome once again to Weekly Profit Talk. As you might imagine, we do this every single week on Wednesday at 8:30 a.m. Mountain Standard Time, or Mountain Daylight Time's coming in another month or two, I imagine. Good morning, everyone. Welcome. We're well on our way through February here. Tax season is kicked into full gear, and this week's topic is why a big tax refund is bad news for private practice owners. And As is quite often the case, some of these topics will bleed over into uh, help for people that don't happen to be medical professionals, but we kind of target that audience and we just want to make sure that we're providing good information. If you're not a doctor, stick around. You might hear something that'll help. Let's go ahead and we'll get started here. Why is a big tax refund bad news? Well, I'm about to tell you. This is actually a favorite topic of mine. First things first. The huge tax refund myth is basically it is a myth. Now, chances are um, this comes from W-2 wage earners, which is a very nice way to basically make your money if you're starting out in life. You're basically right out of college, or maybe even right after high school. You've got some kind of job, and basically, if you earn a W-2 wage, then you're getting a pay stub or a pay advice on a periodic basis. It could be weekly, bi-weekly, or semi-monthly, which is my personal favorite because you have two paydays every single month of the year, all 12 months, 24 pay events. No matter what, each of these pay stubs is going to have a certain amount of money taken out of it. Federal income tax, if you are in one of the 41 states that has the state income tax, there's withholding for that as well as two other things, Social Security and Medicare. Now, if you are working for someone else and they're providing you with a paycheck, then they have to pay half of your Medicare and half of your Social Security. You pay the other half. Okay. That's taken out all the time, so you really don't have to think about your withholding. And at the end of the year, you file your taxes. And if you paid more into the United States Treasury than you owed in tax, then you get a refund. If you happen to have a shortfall, then you'd be looking at owing them some more money, but that's kind of rare. And what people will often do is do zero exemptions, or the new W-4 form is to basically withhold as much money as possible. You can check the has second job box and it increases your withholdings, for example. Make sure you're withholding as much as possible. You don't have to think about the tax when you file. You'll get several thousand bucks back. Does that sound good? Well, I'm going to tell you it is not good. And I'm showing you right here. Would you give an interest-free loan of thousands of dollars to a stranger? That if the answer, obviously, no, why would you do that? If that's the case, then why would you give one to the world's least grateful borrower? And we are talking about the Internal Revenue Service. That's right. What happens is this. Let's say that you over withhold a couple $100 a month, well, several $100 a month. So at the end of the year, you've got $6,000 and you're like, that's great. I've got a big refund. I'll go out and I'll buy something. Maybe I get a used car, or maybe you play guitar and you go out down to the music store and buy a brand new Les Paul, something like that. Doesn't that sound awesome? Well, the thing is, first of all, and I've made this quite clear, H&R Block and Jackson Hewitt do not have magic refund powers, okay? Basically, it's a function of money in, money out. If you withhold too much, any fool with about 40 hours of training can do that tax return for you. Honestly, if you go to somebody that's more professional, they'll probably find you even more money, depending on what it is you do for a living, what kind of other forms of income you have, what other kinds of deductions you might have, family situation. There's all kinds of things, questions you need to ask. So a $6,000 refund means the government used your money for free at the rate of $500 a month all year long. And what did they pay you for the privilege of holding your cash? Absolutely nothing. They don't pay interest, and they don't even send you a thank you card. They're, like I said, the world's least grateful borrower. It's a scheme. And furthermore, and I want to share this with you too. If you happen to have a job and you fail to file your taxes, they don't care. Um, if you leave a refund unclaimed for over 3 years, you basically lose the ability to claim it. And I'm going to tell you, that the United States Treasury makes about $50 billion a year in unclaimed refunds. 50 billion. That's nine zeros. Well, 10 zeros with the 50. That's a lot of damn money. So, folks, big refunds are bad. They really are. Now, what's the cure? As a medical practitioner, or let's say that you just run some other kind of small business. So, chances are, if you're making over $100,000 a year, you may or may not have been introduced to the idea of electing to be taxed as an S corporation. So that means you're getting paid two different ways, or more exactly, you're getting taxed two different ways. You have to take a wage from your S corporation, which is called reasonable compensation. That portion of your income is taxed for Social Security and Medicare. Uh, the Social Security and Medicare part that you're paying yourself as an employer is actually a write-off, so there is that. Um, and then the remainder of the income after all your other overheads is something called net income. And as long as you take less out of your business in the course of a year than you make in net income, you're entitled to that as what's known as distributions. So you basically have two forms of income. Let's say, for example, that you make a nice even $100,000, and I've set you up to take $4,000 a month or 48,000 a year in wages. So that remaining $52,000 is net income. It is not subject to FICA. The only tax you're going to pay that is ordinary income tax. Um, Social Security and Medicare combined, after the page one adjustment for gross revenue, is an effective tax rate of a little over 14%. So you will save, see, on $52,000, I'm going to say I think that's probably about $7,300. That's right. If you file as a sole proprietor, you're going to basically be paying $7,300 more than you would as an S corporation. So this is why it's critically important that you do quarterly monitoring. Now, what we mean here, uh, you're in control of your estimated tax destiny. There are four estimated tax payment deadlines each calendar year. They are the 15th or the next weekday after uh, of April, June, September, and January. Now, each of these, you have an opportunity to pay the tax on your projected income performance as you have arrived at it for that particular period. So the April 15th, what you want to do is estimate your income on the first 3 months of performance because you have three full accounting cycles, January, February, March. Okay. So all you got to do is multiply by four, figure the tax on the whole thing, divide the tax by four, round it to the nearest $100 down, because you really just need to pay that to within $1,000 and make it as an estimated payment. And don't forget to do the same thing for your state. Okay. And that is going to take into account all your other overheads. If you're married, if and your spouse has income, you basically want to estimate your tax four times a year and then do the division problem, subtract whatever estimated tax payments you've made earlier in the year for the June and September, and you can adjust as you go. Like it says here, did you happen to overpay in the first quarter because you finished the previous year strong? Then just for quarter two, basically it's just a matter of ensuring that you are paying tax based on the actual performance of your business. Second quarter, that's a weird deadline. It's in the middle of June. But all you got to do is the first 5 months of the year, January through May. And that's how you do that. So the object of the game is to owe no more than $1,000 when you file taxes, or um, basically have the IRS owe you no more than 1,000. So the bullseye is actually a $2,000 bracket. Honestly, I try to hit the 500 on either side mark, and we have quite a bit of success with that actually. So um, now, why is that important? Because again, you're going back to the previous slide that I just showed you. If the IRS has $6,000 of your money at the end of the year, they're basically using that interest free and you lost your earning power. You could have spent that $500 a month on any one of a number of things. If you had put it in savings, and there are high yield savings banks online that are paying in the high threes or even low 4%. Um, that's your money. But if the Treasury held it, they got it instead. That's why you want to make good, accurate quarterly accounting estimates. Now, the last thing I want to touch on real quick, and we'll wrap up quickly here. If you're already anticipating a huge 25 refund because, hey, the year's over, this is the first time you're hearing this, that's great. Actually, first of all, don't feel bad about it, but you can fix this. And the other thing is if you're a small business and you should have been making estimated payments, or let's say, for example, actually more exactly in this scenario, if you've got a huge 25 refund coming, this 25 to 26 may be your actual first year in self-employment. Um, so you've got an opportunity to actually make your first quarter estimated tax payment. The Form 1040 will actually ask you if you would like to apply some of your refund to estimated taxes for the current year. Just check the box yes and put an amount in. If it's the whole amount of your refund, you can do that. Or if it's a portion of it, then give them a portion of it and keep the rest for cash and go to Disneyland or whatever you'd like to do. But you can basically turn your previous year's oversight, sorry about the bad spelling, into this year's cash flow advantage. Um, so to wrap up, basically, big tax refunds are bad news because you're basically, and I want to go back to this phrase because I love the way it sounds. You are basically giving an interest-free loan to the world's least grateful borrower. So let's stop doing that and start being smart with our taxes. It's basically a matter of fiscal responsibility. You owe it to yourself and your family to keep as much of the money that you're working hard for as you possibly can. So with that, let me wrap up for now. We'll have another neat topic next week on Wednesday at 8:30 Mountain Time. That is 7:30 on the West Coast, 10:30 on the East Coast. If you'd like help with any of this information or want to explore how expert business advisor and tax planning guidance can help your business, I'm coming to you on YouTube, LinkedIn, and Facebook. And any one of those three have a comments capability. So pop in the comments, help, or more info, or reach out to me, or whatever you want to say. Um, Love your videos. That'd be great to hear. Matter of fact, if you're on YouTube, do me a favor, mash the like button while you're at it. So in any event, if you write to us, we'll see it within 24 business hours and get back to you and tell you how you can have a free 45-minute conversation with me, talk about how we can guide you into greater prosperity and lower taxes. And we're love helping you with both. So let's talk about that soon if you want. So until next week, have a great rest of your Wednesday. And if you have a chance today, do something randomly kind for a stranger. So until next week, so long, and we will see you next Wednesday.